Okay, let me tell you a quick story. Back in 2004, a guy wrote a check for $500,000 to a college kid with a brand new website. 8 years later, that one check was worth over $1 billion. That's not luck, that's the power and the danger of startup investing. And by the end of this video, you'll understand exactly how it works, from the very first dollar to the billion-dollar payday. Hey, I'm Flocky. Give me a few minutes, and I'll make money make sense. Today, how startups raise millions. Seed funding, angel investors, equity, valuations, all explained like you're 5. Let's go. First, what even is a startup? Picture a corner bakery. That's a small business, built to make a steady, reliable profit, year after year. A startup? Totally different animal. It's built to grow fast and huge, often before it makes a single dollar of profit. And that one difference changes everything about how it gets funded. Here's the problem. A startup burns cash long before it earns any. Engineers, servers, marketing, all paid up front, while the revenue shows up way later. So founders sell the one thing they actually have, a piece of the future company. And that piece has a name. It's called equity. Startups climb a funding ladder, and every rung is bigger than the last. Bootstrapping, friends and family, pre-seed, seed, then Series A, B, C, and beyond. So let's climb it, one rung at a time. Rung 1, bootstrapping. That's the founder, using their own savings, no investors, total control, but limited fuel. And a lot of famous companies, they started right here, in a bedroom or a garage. Rung 2, friends and family. These are small checks from people who believe in you. Not the product yet, just you. Usually a few thousand to tens of thousands of dollars. The first real vote of confidence. Rung 3, pre-seed. This is the first real outside money, often from angel investors, used to build a rough prototype and prove that people actually want this thing. Still tiny, but now it's official. Now, the main event, seed funding. This is the money that plants the company, the seed, that everything grows from. Today, a typical seed round is roughly $1 to $5 million. Used to build the real product, hire a small team, and find your very first paying customers. So who hands over this seed money? First, angel investors. These are wealthy individuals betting their own money very early, writing checks from $10,000 up to a few $100,000, all hoping to back the next big thing before anyone else sees it. Second, seed stage venture funds. These are firms whose entire job is to find tiny unknown companies and hand them rocket fuel. In exchange, of course, for a slice of equity. Here's the trade at the heart of it all. Investors give cash, founders give equity, ownership. But it's a tightrope. Sell too much, too early, and you can lose control of your own company. Sell too little, and you can't raise enough to survive. Every founder has to balance this perfectly. Before anyone invests, both sides agree on one critical number, the valuation, what the company is worth on paper. And it comes in 2 flavors. Pre-money, the value before the investment goes in, and post-money, the value right after. Keep those 2 in mind. Here's why they matter. Let's make it real. Say Flocky's app is valued at $4 million pre-money. An investor puts in $1 million. Add them together, 4 plus 1, and the post-money value is $5 million. So that investor now owns $1 million out of 5. That's 20% of the company. That's the whole magic trick. Cash in, ownership out. But here's a twist. Super early on, founders and investors often skip fixing a price at all. Instead, they use something called a SAFE, a simple agreement for future equity. The investor's money converts into shares later, at the next big round. It's faster, it's cheaper, and these days, it's basically the startup standard. Now, for the brutal truth nobody tells you. Most startups fail, and investors, they know it. They're counting on it. Their entire model is something called the power law. Back 10 companies. Expect most of them to die, but 1 or 2 to win so massively that they pay back every single loss. and then some. The losses are just the cost of finding one rocket. After seed comes Series A, usually tens of millions of dollars to scale a model that's already proven it works. Then Series B, C, and beyond. Each one a bigger check, a bigger valuation, pushing the company higher and higher. Behind those giant checks are venture capital firms. And they don't just spend their own cash, they raise huge pools of money from pension funds, universities, the wealthy, then spread it across dozens of startups, all at once. Now, for the brutal truth nobody tells you. Most startups fail, and investors, they know it. They're counting on it. Their entire model is something called the power law. Back 10 companies. Expect most of them to die, but one or two to win so massively that they pay back every single loss, and then some. The losses are just the cost of finding one rocket. So how does anyone actually cash out? Two ways. One, an acquisition, where a bigger company buys the startup outright. Or two, an IPO, where the startup sells shares to the public on the stock market. That's the magic moment, when paper money finally turns into real money in the bank. Remember that $500,000 check from the start? That was Peter Thiel. Betting on a young Facebook, it grew into more than $1 billion. And go back to 1998. A man named Andy Bechtolsheim wrote Google a $100,000 check. Before the company even legally existed, it became one of the greatest investments in history. Tiny seeds, giant trees. So now you're wondering, how do I get in on this? Here's the catch. In the US, most early startup deals are reserved for accredited investors. Roughly, people earning over $200,000 a year or worth over $1 million. But the door is cracking open. Equity crowdfunding now lets regular people put in small amounts. Just never forget rule number one. Never invest money you can't afford to lose. So that's the whole journey. From bootstrap savings, to friends and family, to seed checks, to venture capital, all the way to $1 billion exit. Every giant company you've ever heard of started as one risky little seed that someone decided to plant. So if this finally made startup investing click for you, hit subscribe. I drop one money story like this every single week. I'm Flocky. Now go, make your money make sense. And I'll see you in the next one.